Welcome back to another week of the Educated Home Buyer Live. If you're confused by watching that first slide talking about the webinar, well, that's because I hit the wrong intro to come into this. The webinar was 2 weeks ago, so you can't register for that at the moment. We are going to do another one here in the next couple of weeks, but just to clear up any confusion.
Jeb, the good news is they can, in fact, register for it because you can't. Oh. There's apparently no way to take the registration down. So we had 3 or 4 registrations this week.
Well, that's not a good thing. So we need to figure that part out. But anyway, guys, welcome back. Tonight we're going to be talking about, Trump's initial tariff that was put on Canadian and Mexican imports. It's since been halted, but we're going to talk about that impact on the housing market. We're going to update you on what's happening out there with inventory, with buyer demand, with mortgage rates. More importantly, we've seen a lot of positive news on the mortgage rate front, and that is going to impact housing affordability in a positive way. So we're going to take a look at that. And more importantly, we're going to answer your mortgage and real estate questions. That's why we're here. So, after you let us know where you're watching from, which we always appreciate, start putting your questions in the chat, and that way we can just flow right into it and have a gangbuster show, Josh.
Flow Rida? You said you're Flow Rida? You're dating yourself.
In Flow Rida,
20 years
the
old.
HOA fees are high, the taxes are high, inventory's piling up in Flow Rida, and things are not what they are here in Southern California.
We've got a slide that shows that.
We got a slide. So, Josh, let's just, before we jump into slides, tariffs and the housing market. It's kind of like oil and water to some degree. 25% tariff is we kind of talked a couple of weeks ago when we talked about things that could be implemented, and we said that he probably doesn't actually want a 25% tariff. He's just using it as a negotiating tactic, and he signed it in, and guess what? Negotiations started, and all of a sudden it's on hold. So if it does actually happen, what does that mean for the housing market, Josh?
Well, let's just say for the economy as a whole, it would be bad. It would be bad for the Trump presidency. One of the things that voters made very clear is they were pissed about inflation, and it would have been inflationary, at least in the short run. We've talked about it. It's really a reset on prices. And then after 12 months, assuming no additional tariffs added, it's not continual inflation. It's not a continued increase in rate of prices increasing, but it absolutely would in the short run. And people would not like that. And those who voted for him, convinced that he was going to fix inflation, would have been mad. So if you go back, we did a couple of episodes. We did one prior to the election of what he might do. We did one after the election of what he's telling us he's going to do. The tariffs all the way up to, rescinding them. He said, this is what I'm doing. Like, don't doubt me. I'm going to do it. But in retrospect, it was a classic Trump negotiation. I'm going to hold this giant sword over your head. And if you don't give me what I want, I will cut your head off. And both China and Mexico not China, both Canada and Mexico did what he wanted. And it's kind of crazy because the tariffs were not really directly aimed at what he was most concerned with, which is drugs and border security. So from that perspective, it would have been, I like the outcome. I wish we had got there in a more friendly, diplomatic manner with less concerns for everyone, but they're on hold for 30 days. They're not coming back. Had they been in place, it would have been bad for the economy. And I think as a result, bad for housing. The China stuff is a whole different animal. They didn't give in. They've put retaliatory tariffs in place, but it's a very different issue. His issue with them clearly wasn't the border and drugs. Although, Jeb, we did see a very interesting video from an investigative journalist who says that it is all tied together, that China is behind the fentanyl, with many of the precursors being made in Canada, then shipped to Mexico, brought back across that border. So it's above our pay grade. But let's just say for the time, crisis averted, and that's a good thing. But what are your thoughts?
No, I mean, I don't think a lot of Americans realize that lumber supply, things that are used to build new construction property, comes from Canada, comes across that border. And so the 25% tax is implemented. If that were the case, then that means building costs are going to go up, more expensive for housing. We're already in a housing affordability crisis in many ways, and that only adds to it. So like you said, it's on hold for 30 days, probably for a longer period of time. So at the moment, it's not right on the table. And this thumbnail, the video title was created before all of that actually went down. So I'm glad that's changed because it's less of an impact. But with that, we've seen some positive things happening in the economy. And that's what we're going to translate into right now, Josh. So with that, we're going to take a look at charts. We always like to start with inventory. Inventory actually saw a tick down nationwide this past week, which again, kind of a rare occurrence to see that what we've seen so far through the start of the year. But inventory of unsold homes ticked down, not a lot, but went to 635,000. So I think just less than 1,000 homes, which, as you can see, 636, 580 down to 634, 979. So just over 1,000 homes is what it's been. But inventory is going the wrong direction. But again, it's not something to be so concerned with at the moment because this isn't the time of the year where we start to really see the increases anyway, right? We're a couple of weeks off from seeing that normal tick up in inventory. So let's just hold tight here for a couple of weeks and see how that plays out. But anyway, peak for last year was 739. I think that's the number, kind of using as somewhat of a base case for this year. But a lot of experts are thinking it's going to be somewhere in the nines by the end of the year of unsold single family homes. And that's basically back in 2015, this time of year, we were sitting at 936,000 homes. So we're still below where we were in a more traditional market, but it's headed in the right way for those wanting to see more inventory. That leads us into Orange County and Huntington Beach. We're seeing increases here. Orange County saw 3.7% increase week over week to 2,888 homes. Now that's single families, condos, townhomes, everything. That's not just single family homes. Same thing with Huntington Beach. We actually saw almost a 9% increase week over week to 205 homes. These are the highest levels that we've seen since, early December. So, we're starting to see inventory go in the right direction. And my guess is you're going to see it continue to increase for some period of time. So 49,000 new listings unsold. It's a bit fewer than a week ago, but 10% more than last year. In total, 4% more sellers than a year ago. So again, more listings coming to the market. Why? Couple of reasons, right? It's that time of the year. Again, it's also people wanting to do something, right? These people that have been tied into these properties that said, I will never do anything. I'm going to be in this house forever. It's got a 3% interest rate. I'm going to die here. Said, you know what? Maybe I'm not going to die here. Maybe I do need some more space. Maybe I do need a different property. And so you're going to start to see some of that inventory unlocked. Which is a positive thing for the housing market. So home prices up 2.5% above last year, with pending home sales sitting at 389,700, with the median price on the active market at 424,900, which is essentially unchanged from last year. Basically, any way you cut it, home prices are more or less flat year over year, which is kind of what you've been hearing across the board.
Well, hold on. Tell me how 2.5% increase is flat.
Well, if we're talking
$10,000 on a $400,000 house,
in real terms, we're flat, right? So, inflation.
Agree to disagree. To me, if I pay $10,000 more, for
agreed. I agreed.
$65 more in a monthly payment.
The way they're saying home prices are flat is in real
relative
terms,
to the craziness of what we've come to think of as normal for the last 4 or 5 years.
Home prices are not down. They're not, they are definitely up year over year, but not compared to what we've seen, over the last 4 to 5 years. So compared to that, we are definitely flat. Home sales averaging 4.7% below last year. Is that right?
That is not flat.
That is definitely not flat. Why, Josh?
Lock in and affordability.
Yeah.
So, and the lock-in is due to affordability. The people that want to move up, move down, move to other parts of the country go, whoa, it's going to cost me what?
Yep, exactly. And so this week, 56,000 new pending home sales, 1% more than a year ago. Sales have been averaging almost 5% fewer than early 2024. Any positive news is essentially welcome. And that leads us into price cuts, Josh, ticking up a little bit, sitting at 33.1%. So, if you look at this chart, comparing it to previous years, we're going to be higher probably than what we've seen over the last 4 to 5 years. I mean, even longer, for that matter, with regards to price cuts. And again, it's affordability being a big piece of that puzzle.
And some of this is psychology. Like right now, the market is convinced we're never getting lower rates. So these prices, these rates, this is what affordability is. I'm not willing to do that. So that's sort of where you see that it's not really an inflection point if the purple line is going sideways, but it's going sideways when previous years have been dropping. So from that perspective, we're going to get into that, Jeb, in a minute when we go through the interest rate stuff. In that, as you hinted at, there were some positives this week. And again, cautiously optimistic that we see rates come down. And if and when they do, in even the smallest of measures, then we'll see lines very similar to the other two colored lines, which aren't great, but better than where we're at right now.
No, absolutely. Now, something we often hear a lot of is that institutions, that BlackRock, that these large corporations are buying up all the homes and nobody can buy a home because they are essentially the culprit. Okay. We've kind of talked about this in detail on other videos, but in all, looking nationwide, these corporations own less than 1% of residential real estate. With that said, there are some pockets out there where these institutions own a larger percentage than 1%, right? So if we're looking at this chart down bottom left, I put the top 5 cities where where there's more concentration of these institutions than other places. And essentially, in order to meet the guidelines here, they have to own at least 1,000 homes nationally, in order to be considered institutional in this case. But Atlanta kind of leading the spot, 4.33%, Jacksonville 3.77%, Charlotte 3.23%, Memphis at 3.11%, and Tampa 2.85%. So Josh, what is the correlation with those areas? Why that area versus a Southern California or a New York or some of those markets?
I would say a couple of pieces: more developable land, easier regulations, less costly permitting, but affordability. The affordability is higher there, and many young people fleeing the Midwest and the Northeast, at least during COVID, which we've seen a little reversal of this, for warmer climates. So you have a young population wanting to move to warmer areas that have had good economies. You know, Georgia has had a good economy. Florida has had a good economy. So from that perspective, that's why it's attractive. Also, Jeb, lower purchase prices, right?
Sure.
Does an institutional investor want to buy $10 million homes or $100,000 homes? Not that there's a lot of $100,000 homes.
No, but again, why are they buying these up? It's rental demand, right? It's how can we buy these properties? What do the rents look like relative to the prices that we're paying for them? So on and so forth, right? Buying a $700,000 home in California, isn't going to give you the same return as buying a $250,000 home in the South. So it's all about quantity, in many cases over quality and appreciation. It's all about that because these institutions many of them are publicly traded, right? There's returns for investors, there's returns for other people in these. So they, and that's what they're thinking of in these situations. But I digress. So Josh, we have Zillow. Zillow puts out this heat map, and the darker the color, the hotter the market. And as we can see here, we've been hearing about the Northeast, how it is still a seller's market, strong seller's market, where multiple offers, properties selling above the asking price. And at the same time, we've heard that Florida is opposite of that entirely. And so you can kind of see this map is telling us exactly what we're hearing from our viewers out there watching the show.
The only part to me that is surprising is seeing the big peach and red bubbles on the West Coast here, because you hear a lot. CoreLogic is, when we talk about CoreLogic, is always more negative and more pessimistic. But when they put out their numbers, like, oh, the West Coast is in trouble. But you look at the Bay Area, you look at Southern California, you look at Seattle, you look at Portland. They seem to be doing fairly well. And anecdotally, from people that I know, contacts, friends that I have in those areas, that's exactly what we're seeing. We put one under contract this week in San Jose. Had a very easy time selling their condo. Had to make multiple offers to get a house under contract. But yeah, that's what I would say. This is just confirmation of what everyone is seeing and hearing.
All right, good stuff. That takes us into purchase applications. Josh, we're seeing a
It's
tick up.
better than the applications. It's PAPI. It's the Purchase Applications Payment Index.
Ooh,
So this is a number that I was unaware of until very recently. The MBA puts this out on a monthly basis, and they look at a number of things. I got to get back over here to my numbers so that I can tell you exactly and correctly what it is. So it's you want to see a lower figure. So that coming down is an increase of affordability, but what they're measuring is the debt to income ratio or the housing to income ratio, not all your debts, but just the housing to income ratio. And it can change in a number of ways. So a decrease in this is indicative of improving borrower affordability conditions. And there's really only three things that can move this. And it's slightly different than what we talk about, Jeb, when we're talking about standard affordability. Loan application amounts decrease, mortgage rates decrease, or earnings increase. So you've seen, I put those purple dotted lines to kind of show a range here. Post 2022, when rates spiked, we went to the high end, and it's kind of hit that twice and then come back down. We would like to get out of that range. We're kind of trending sideways right now because home prices, as you said, are flat. They're going up nominally. Wages are not flat. Wages are going up at a much higher rate. We're not talking 20% wage increases and 2% home price increases, but on a measure of like 2% to 4%. So that increases affordability. But the other piece in there, loan application amounts can decrease. So not home prices, but we talk about like home builders. When you see the median home price for new homes is decreasing, that doesn't mean home prices are dropping. It means that builders are building smaller, cheaper homes. Well, in this instance, as people get priced out, they can adjust and say, I'm gonna get a smaller loan, so a bigger down payment, a cheaper home, any number of those things. So thought that was interesting. And then the fact that this thing went all the way back to 2009, Jeb, that little green highlighted box that I threw in there, if we all had a crystal ball and we were of
I did buy then.
legal age and could buy then. So yeah, when did you buy your place? When did
December
you
of 2012.
Okay, literally the perfect time to buy.
No, it
That
really was. And it
was
wasn't because I knew something that everyone else didn't know. It was the right time in my life, Josh. We talked about it today.
And you see that red line. So affordability got worse, worse, worse. Mainly interest rates stayed low, very consistent through those timeframes, but home prices were increasing from like 2010 to 2020. So at that time frame, it doubled. And then you're like, well, what do you mean home prices doubled? Because we saw this drop back down in January of 2020. We almost had affordability like when Jeb bought in 2011. So you look at that, that was because rates plummeted. So through that time, we see prices going up, and we get to the top end of that affordability, and now rates are the primary reason here. So I say primary reason. That's not to say that home prices aren't really high. By almost any measure historically, they are very high, but it wasn't a problem until rates jumped into the party as well, because we were within that range of what we normally see as affordability based off of PAPI. We're going to talk about PAPI every month. I just like saying it, Jeb. So this week is jobs week. Most of the data we're looking at is going to be jobs related. So JOLTS came out earlier this week, moderating again. So you can see going back to mid 2022. And what is the reason? The job openings and labor turnover survey. So when there's a lot of job openings, the fear is that the supply and demand equation there is tilted towards employees, and they're going to get paid more, and that's going to lead to inflation. So no one wants there to be no jobs available, but we don't want too many jobs available. We're looking for Goldilocks, and we're moving in the right direction. Today, Jeb, we got the ADP jobs report, moderated a little bit. It was a little bit better than expected. But when we look at that, this green line, I had to draw it because there's not like a curvy line in there. You got to draw it by hand, Jeb. That's a pretty straight line for drawing it by hand.
Okay.
But you saw it had dropped precipitously through early 2024, and now we're kind of moving sideways. And if you look here, September, October were when we kind of saw it trending back up. So we had this dip in interest rates, and that was about when interest rates started trending up, because again, the fear that if we have a strong jobs market leads to wage-based inflation. So the big one is coming on Friday. This is through the January data of that is the December report, or the December data that is released as the January report. Not a whole lot of a pattern here, as you can see, Jeb, bouncing all over the place. This chart, I liked it because it throws the 3-month rolling average in there. And even when we do a 90-day average, it doesn't smooth this out a lot. It's up, down, up, down, up, down. So the expectation for tomorrow's report is 170,000 jobs added. Last month, we got like 260, 256, something like that.
Friday.
There's
Friday, right?
Oh, Friday, you are correct. Tomorrow we get the weekly claims and continuing claims. So Friday, Goldman Sachs thinks we could see this as high as 190, Bank of America as high as 200,000. Interestingly, Bank of America says that the wildfires here in California could have cost 15 to 20,000 jobs on this report. So it could come in low and it could get waved off just as sort of fluctuations there due to the wildfires. The unemployment rate expected to remain steady at 4.1. So absent that going up, it's not likely to be a huge difference here. And Bank of America also said they expect downward revisions to be concentrated in the second half of 2023. We saw that a lot last year. So we're going to get some revisions on Friday, and they think they're going to be fairly minor, and we'll see the bigger revisions in the second half of the year. Jeb jumped the gun. He usually asks me, are you done screwing around with the slides before he imports them? So we have a blank one here. That slide, it was basically just showing we had PCE last week. We have PCE coming next week, and that is the Fed's preferred measure. Both still elevated, but both looking like in the next 2-3 months, we're going to be well in the mid to low twos and making progress towards where the Fed would like them to see. And in response to that, this is the futures market probabilities still saying out of the market in March, the next meeting's in March, out of the market in May, the next meeting after that. So until we get to June, the market is not pricing in cuts, and then till December, another cut. So we're gonna have a ton of data between now and then, seeing what inflation is doing, what Trump and the tariffs are doing, and then on top of that, what we see from the jobs market. So Jeb, why not here? You called this a couple days ago, and we're expecting, hoping, predicting, praying that Friday we do get a slightly weaker jobs report, and we'll see some follow through on this. Why don't you tell them what we're seeing here?
You tell them it's your chart, but yeah, I mean, my chart looks a little bit different, but essentially you've got, you know, the 10-year. We're looking at 10-year here, not mortgage-backed securities.
Yep.
We got the 10-year breaking out of the bottom of a channel, headed lower, right? There's a couple of points of resistance there with it moving downward. Ideally, we want to see it move down, right? The lower that moves, in theory, the better interest rates are going to get. So we want to see that. We want to see it go to the bottom of that damn screen if we can. The reality is that's not going to happen quickly, and so, you know, those green lines you see going across there are areas at some point in the past that have either been support and or resistance, and we need to see a breakthrough through these lines, and that's essentially where we are at the moment. We're sitting somewhere around 4.4, low 4.4s. You know, next spot I think is somewhere in the low 4.3s. But the lower we go, the better off you are on the interest rate side, is more or less what it boils down to.
Absolutely. So interesting to people who like candle charts, less interesting to others. Yeah. What does it mean? As of today, Mortgage News Daily shows back under 7% by the slightest of margins. Slight improvement day over day, similar improvement over the week, you know, maybe 1/8 of improvement over the month, and actually back seeing green year over year on most of these loan programs. Looks like government loans are a little bit worse, but okay, nothing to get super excited about or write home about, but definitely to be hopeful just in terms of looking at what's coming in. And we could see a trend change here if we get a weaker jobs report, if we see some follow through. And that was all in spite of the tariff hullabaloo. Like I was watching, Jeb, last weekend, I was watching the futures market all weekend going, they said on Saturday when the markets are closed that we're going to have these tariffs, and you didn't see much movement, and there was a slight improvement in 10-year yields, and then it all hit on Monday. So it'll be interesting.
Yeah, I've been somewhat pessimistic with regards to the 10-year chart, because I've seen a lot of levels of support for higher rates. It's weird in the way these charts, when I say support resistance, I'm used to saying it the other way around. So I haven't seen a lot of opportunities for them to head lower, just because I've seen so much resistance keeping them higher. Recently, the way I've been looking at my charts, a lot of these areas have been passed. And so I see an opportunity for lower yields on the 10-year, which leads to lower interest rates. So it's weird how these things play out, but typically speaking, there is a news report, something that happens at the same time these charts are at a level where they could break. And so my assumption is that there's something with the jobs numbers on Friday that lead us to lower yields on the 10-year. That's what I'm going with. And next week we'll see if I'm right. Actually, we'll see it on Friday, but you won't see it until next week.
You'll hear about it next week. Jeb will be gloating about how right he was.
No, not at all. I'm hoping that lower rates for everyone. But with that said, interest rates are headed in the right direction at the moment. We've seen, probably a 0.25% improvement over the last couple of weeks. If you're somebody that's considering refinancing, you're not already on the rate watch list, jebsmith.net/rate watch. Get you on that list. So as mortgage rates move down, we can be in touch with you so that you don't miss that opportunity if refinancing is an option out there. With that, Josh, I think that is it. It is time to talk questions. And if there are any questions, Josh.
We don't hardly have any questions. We have to beg you guys to ask questions. So it's quiet if you have a good question, or even
we're here for your benefit, guys. Josh and I love talking housing, but we do this a lot off the air. So if you guys don't need us, we can get our Wednesdays back, and you guys can enjoy, some other YouTube. But
Wing Wednesday.
If we can be, let's start asking some questions. So Roberto says, are people having trouble finding home insurance in Anaheim Hills and Rancho Santa Margarita? I'm seeing a lot of listings in these areas compared to other areas in South Orange County. So I can't speak 100% fact on this, but my assumption is probably high likelihood that insurance premiums are higher than people are willing to pay, want to pay, and or it's difficult, right? Some of these carriers are saying we won't do it. With that, there is something called the Fair Plan, California Fair Plan, where you can get insurance, maybe not what you want to pay, but there is opportunities out there. I know, Josh, you had one last year in Rancho Santa Margarita area, Foothill Ranch, and I think she ended up going California Fair Plan.
Ended up with Fair Plan, and just so you know, that truly is just fire insurance. Yeah. So you can't get fire insurance anywhere. Here is state subsidized or state provided fire insurance, and then you need another policy on top of that to cover all of the things of yours, your liability, your personal property, all that stuff. So it ends up it's expensive. It's subpar coverage relative to a normal comprehensive policy, and you end up having to cover it with additional coverage. I've got a listener to the show here refinancing in Woodland Hills right now, and that property they were evacuated. They were like a block or two away from the fire. Their fire insurance is dropping them, and in terms of replacing it, I think it was Farmers would do it for $8,000 a year, and it is a $1.5 million house. Farmers would insure it for $8,000 a year, or they could get a $2,000 Fair Plan with a $2,000 policy to go along with it.
All right. Forgot to mention earlier about the Educated Homebuyer podcast this past week. The episode that dropped, again, goes into more detail about Trump's policies. So if you haven't listened to us talk about Trump and policies and how it's going to impact housing, make sure you do go check that out. A lot of good information there. Today, we recorded an episode on what you have to be paying attention to in this housing market. That's a week or so out. So either way, hope you're getting some value out of the actual podcast there. If there's something you want us to chat about, you can email us. There's an email in the description of this video. You can always put it in here. We'll take it into account as well. But we really want to be providing you with the information that you want to hear in order to make informed decisions. And with that, I know a lot of you are out there shopping, looking for realtors, looking for mortgage professionals. If we can be of assistance, our team in here would love the opportunity to guide you. And you can do that using that referral link. I forgot to change it again, Josh, but jebsmith.net/referral will get you in touch with Josh and myself. So, Josh, let's go. Got a couple questions here. Chris wants to know why I shaved the beard. Chris is probably the biggest supporter of the beard on the channel.
I wonder if Chris is someone that can't grow a beard, so he's fascinated by your very masculine beard.
The beard is gone. It just, I started looking in the mirror. It just felt like I was looking 10 years older than I felt like I was looking like Josh, and I just didn't want to look 10 years older.
You dream, my friend.
The beard had to go, and we shaved it down, and then I said, I gave it like a week and a half, and then I went, went down again. So this is going to be the summer look. We're going to go back. We're going to come back in the winter with a vengeance. I'm going to use horse shampoo, the whole thing. We're just going to we're going to get it thick and going to let it grow. I say that every time. We're not going to do that.
Never.
It's a lie. I'm lying.
Never.
Anyway, Caesar is asking 7.75% for a refinance on an investment property with a 780 credit score. Does that seem right, Mr. Josh?
It does not seem right, but it could be. It's not egregiously high. I mean, you hear it and you go, yes, it is. I say it's egregiously high. If it were a condo, you have some condo hits in addition to the non-owner hits. I've got two non-owner refinances going right now at a significantly better rate than that. So use that referral link, reach out. Would love to go through the numbers, even if it's just to say, hey, this does make sense. We can give you some peace of mind there that you're good and you're on the right track, or hopefully we can save you a good chunk of money.
Good stuff. Night Panda coming in strong with the $10 super chat. We appreciate you. Night Panda. Didn't Night Panda register for the webinar as Night Panda?
I believe so.
That's strong. You know, when you start going,
I am what I am.
Yeah. When you've figured out who you are and you just say, that's who I am.
It does throw me off though, that it's a picture of an orange cat. I was expecting a blacked out, all dark panda. That would be awesome.
The cat's name is Night Panda.
I'd like it, but I would expect that cat to be black if its name is Night Panda.
See, that's where you're wrong. You think everything should be correlated. Doesn't
you
mean
can just randomly.
You can do whatever you want, Josh. That's the world that we live in. Miscellaneous of whatever says, I'm hoping I can refinance in 2 years. Is it too early to get on the rate watch list? So Josh, people that are looking to refinance further down the road, should they be on this list or should they wait to be on it?
Jeb,
how's that work?
The next educated homebuyer t-shirts to come out, they need to just say it's never too early. It's never
too early.
That's our answer to everything. It's never too early. What if rates drop percent next month and you're completely unaware because you're not on our rate watch list? Then you would be bummed that you didn't do it. Now, conversely, if it doesn't do anything for 2 years and then it drops 1%, the rate watch will notify me and I will reach out immediately to let you know there's an opportunity. So never too early. It's not going to do anything if the market doesn't move. It's just going to sit out there waiting for the perfect moment to notify you.
There you go. Good stuff. Night Panda does have a question though. Says, if my boyfriend is a first-time home buyer and I already own a home, do we qualify as first-time home buyers together if they're looking to purchase, Josh?
Two things. First, most of the programs that require a first-time home buyer, a borrower needs to be a first-time buyer, not all first-time buyers. Some programs do require all buyers to be first-time home buyers. More importantly, most first-time homebuyer programs are not the magic that people expect. You know, a 3% down conventional loan requires you to either be home ready, home eligible, home ready or home possible eligible, which means you meet income limits. If you're above those income limits to be able to do 3%, we have to have a borrower that is a first-time buyer. But you should be fine. You should meet that criteria, but I wouldn't hold my breath. It's not like you're going to get a % lower interest rate, zero down, or some other type of magic program. For the most part, benefits are overblown.
There you go. So Josh, we don't have a lot of questions here. I'm going to go just kind of not off topic, but I'm going to talk about program here in Southern California. Josh can't actually help with this program, but it is helping a client of mine. And I feel like I would be doing you a disservice if you're not aware of it. So if you're buying in Southern California, we're saying Southern California is anything south of Ventura. So Ventura, Los Angeles, Orange County, San Diego, Riverside, San Bernardino. San Diego? Did I say San Diego? Anyhow, there's a program out there that will give you up to $50,000. So LA County is basically $50,000. All the other cities are $20,000. Free money, guys. It can be used towards a down payment. It can be used towards closing costs. It can be used towards buyer's compensation. The caveat is you have to have at least 5% down of your own funds. And you have to qualify under their guidelines, which kind of strict on the debt to income ratio. I think it's about 45%. But if you meet those requirements and the property that you're looking to purchase is on this list, which people are like, well, the property I want probably not on that list. It's probably only in crappy areas. It's not. There's almost 1,000 homes here in Orange County out of the 2,800 that we have listed that are on that list. So there's
that was what I wanted to ask. That would be about 40%. I mean, that's a pretty good,
it's a good number of properties, and it's condos, townhomes. they qualify. And so if they do, you get this money. There's no, it's free money, guys. And you don't have to mention it in your offer. You do have to use the bank that is doing that loan. But what I'll tell you is their interest rates are about 0.25% better than some of the conventional rates out there. And there's no mortgage insurance.
And no mortgage
No
insurance. So
mortgage
I was going to say
insurance.
that when you were
That's
saying, hey,
down.
it's a max 45 DTI, but when you get a little interest rate savings, a little MI savings
Yes,
with
it is a
buying one of
good
these,
program,
yeah.
guys. So I'm mentioning I just got a client accepted this week. He watches the show. In fact, he watched a video that I did on my channel, reached out, and we found him a house in South LA, and he's getting 50 grand for doing nothing other than reaching out and finding the right house. So if you're interested in that, let me know. I'll drop another link in the thing where you can get in touch with, or you can use that referral link and just mention that program, and we can decipher and get you connected in the right way. So hopefully that was
Willing
helpful.
actually has a really good question
Yep,
on
let's hear
that
it.
program.
Let's hear it.
Does it have to be paid back? Is it
It
free
does
money
not.
or does it
It
have
is
to be
free
paid
money.
back?
It does not have to be paid back.
Which
And
if you guys listening at home, we always say, hey, there's no free money. For the most part, there's no free money. There's not a lot of grants. There's a lot of liens, second liens. Maybe they get forgiven over a period of time, but this one's unique.
And then people say, well, why do they do this? Why are banks doing it? It's basically community reinvestment, right? They're required to, some of these banks are required to do this. In this particular case, this bank is doing jumbo loans. Part of their deal is in order for them to do jumbo loans, they have to give out so much money in different areas in order to, I don't know why, but it's community reinvestment. So it is there. It's legit. We're doing it. So if you know somebody interested that's plans on buying, and one of these gets you to go out and buy a house today, just be very, very clear. But if you're already in the process and you're considering one of these areas, it would be a no-brainer not to do it.
Hold on, Jeff. I just got to chuckle. I apologize. SF Miners is back. He's been here multiple weeks asking really good questions. I'm getting a free buy down for 1 year from Rocket Mortgage, basically a 6% for the first year. It sounds too good to be true. Anything that they tell you is quite, you are smart to question and challenge it. There's no magic money. So if you were 1% low for 1 year, and essentially what they would be foregoing is 1% of the loan value in terms of profit. They have really high overhead. Running Super Bowl ads is not cheap. Filling office buildings, even if Dan Gilbert owns them, with cubicle dwellers to take your call 24 hours a day. They do have good technology. Their technology, their app that you're going to use is very good. All of that is expensive. I have yet to ever find someone at the end of the loan go, I got a great deal from Rocket. So from that perspective, take the number, use the referral link, reach out to us. I'm happy to go through it. And if it's a great deal, I'll be happy to tell you. But I am quite confident there is a heavy dose of smoke and mirrors there.
There you go. Good stuff. Let's see. So Night Panda follows up, says, so the lender won't force us to take an investment property loan just because I already own the home, even though my boyfriend does not, Josh.
Well, those are irrelevant. You don't have to be a first-time buyer to get an owner-occupied loan. An investment loan is for an investment property.
Right.
So if you're buying the property to rent out and hold as an investment, you're going to get an investment loan. If you're buying the property to occupy and it makes sense, you can't have a beautiful $1 million house on this side of the street and buy a $300,000 condo on the other side of the street for your primary residence, unless you have a really, really good reason for doing it and you didn't recently buy or refinance the other property. So from that perspective, you're kind of getting your wires crossed on that. The occupancy doesn't have anything to do with whether you're a first-time buyer or not.
All right. Question from Willing says, can you buy a townhome through an FHA loan? And the answer is yes, you can. Let me explain why they're asking this. So FHA, if it's not a single family home, if it's not zoned single family or 2 to 4 units, then it has to be FHA approved. It has to meet certain requirements. And
PUDs don't have to be approved. Condos have to be approved.
I'm getting there. And so depending on how that townhome, quote unquote, townhome is zoned, will determine whether or not it needs to be on an approved list. So most people, when they think of townhomes, a lot of people think, oh, that's a condo or that's a townhome. When in fact, it's actually zoned a PUD or a single family home on title, and you just don't realize how it's zoned. So make sure if you're looking at a townhome or something that you're not real sure about, just ask your lender or ask your real estate agent, assuming they understand how to look these things up. They can tell you, because a lot of people think, oh, that's not approved. I can't get that, or there's going to be some sort of additional fee because I'm putting, even with a conventional loan, because I'm putting less than 25% down, there's going to be a condo hit. No, it maybe not be a condo. It might actually be zoned to single family home, which is in turn going to, mean a better rate. So it's just having the right people to be able to answer the right questions can end up guiding you in the right direction, guys.
Jeb, I'm going to make it more confusing because I don't like it when things are simple and clear. We had a listener reach out and we were looking at some properties. It was a townhome. And I go, well, townhome is more of a property description versus a legal description. So we got to look and see what it is. In Orlando, I pulled a property profile. Townhome is a legal description. And if it is legally a townhome, then it does not need to be approved like a condo. So, it's complex. You want to go through it with your lender up front for all the reasons that Jeb said. It is not easy. And what I will say is, if you're interested in a condo, if you're interested in a townhome that is legally a condo and does need to be approved, we have a great company that literally, Jeb, just happens to be totally inadvertently right down the street from us here on Main Street that does get complexes approved. So if it is a complex that meets all of the requirements, which most of them are, most of them, what happened about 10 years ago, they pulled all of the FHA approvals and the complexes had to go back and reapply. So most times it's not telling you that it's not good, that it's a bad complex. It's just they didn't want to go through the time, effort, and expense of getting approved and maintaining the approval. So if you want that, we can get them approved in a fairly short period of time. Same with VA.
And even better, to make it even more confusing, just to keep adding layers on layers, I have a property down the street that's listed for sale. It's currently in escrow, thank God. That if you looked at it, you would say, that is a townhome. That's a townhome. It is exactly what a townhome should be in every sense of the word. And you look on title, and it's a condo.
So townhome style condominium.
Yes. So just know things aren't always as they seem. So just make sure you're having somebody do the legwork before you get too far in the process or get too excited about what you can or cannot do, because it can come back and not be what you thought it was. Question on employment, Josh. We always have questions on employment. The typical lender, I say typical, most lenders want to see 2 years of consistent income, consistent employment. That can come with some changes in jobs. It can come with changes in income. If somebody were, say, a waitress, right, and then move to selling cars, is that a problem? Because they're both commission, they're both getting, quote unquote, I don't know how a dealer is getting tips, but that's the example they use. Have I not been doing it right, Josh, when getting shown cars? I'm not tipping the dealer.
You didn't tip the guy.
That's why they're screwing me at the finance table.
Yeah, exactly.
Okay.
So the type of job is going to be real important here. If you were, let's take this away, because you just mentioned a commissioned salesperson and someone who makes tips. So low base pay, big chunks of the income is variable wages, that you're going to need at least a year and probably close to 2 years. So 2 years is the guideline. It's not a hard and fast rule. Almost anything after 18 months with an otherwise strong borrower, you can make a good case for it. But you're going to need at least a minimum of a year in that situation. If we had a different situation where, I'm trying to think of an example. We have a friend, it's not quite as simple as easy as this, but was a cop, made X in salary and got offered a salary job by one of his buddies who owns a company, and he now makes a salary over there. That's way, way easier, as long as we can explain why they were qualified for that job and it wasn't just his buddy giving him a job to get the mortgage. Because there's no variable income. When you have that variable income, it definitely gets a little more complex, and the underwriter is going to be a little bit more skeptical.
All right. That is that. TLC, we close on a Toll Brothers new construction property in San Diego in May. What are your thoughts of getting the mortgage through the builder? They're offering only $5,000 in closing costs if we use them. Josh, so yeah, just I'll let you answer it, and I'll ask questions if I have them.
My answer is numbers never lie. So your first step is to get a competitive quote. There you go. We do loans in San Diego. I'd love to give you one. $5,000 isn't nothing. other things being equal, if they're giving you the same terms I'm giving you, you would say, I would like your $5,000.
Sure.
If, Toll Brothers in San Diego, Toll Brothers is a higher end builder. For those of you that don't know, I'm imagining this is not a cheap property. So $5,000, there could easily be $10,000, $15,000 of additional costs in going with their lender. So they're most likely going to require you to get pre-approved with their lender. So do that, get the numbers, and on the same day, get an estimate from them. Doesn't have to be an official loan estimate, but it does have to have a full itemization of the costs. And that's a good place to start, because a purchase is going to be dictated, the escrow and title is going to be dictated by the builder, and the contract is going to look much different than a normal contract. So start with their estimate, and then we'll do an apples to apples comparison and say, if we were to do this today, here's where we would be. And if I go, great news, I can save you $2,000, you go, even better news, they're giving me $5,000, so I'm going with them. So again, numbers never lie.
Yeah. One thing I'll do is, I'll tell you, is that I hear Josh, when somebody has a better deal, he just tells them, hey, listen, that's a good deal. You should move forward with it. So we're not here in the business of being shady or trying to tell somebody or steal business from somebody that's giving somebody good terms. That's the reality, right? We all work hard for what we do, but if you're not getting good terms, we're going to tell you, because the goal here is to educate you and guide you and make sure that you're, at least competitive in what we're telling you. And then ultimately you make the decision. We can't, we can lead the horse to water. Whether or not you drink, it's up to you. So reach out and we can have that conversation. So Josh, Andy would like to know what home ready and home possible loan qualifications look like.
Okay. The biggest one is you got to be 80% or less of the area median income. It used to be 100%, and it used to be, they made exceptions for minority census tracts. So you could make $1 million and buy in the right area and be eligible, but we don't have that benefit anymore. So it really, income related is the biggest one. So the income has to be low enough that you're eligible, but high enough that you qualify debt to income wise. What are the benefits of it? You're exempt from loan level price adjustments. So for someone that has a low credit score, if you get a 650, 660 credit score, a lot of people would say, hey, you're an FHA buyer, because 650 will get you a very good FHA rate. It's going to get you a terrible conventional rate because of those loan level price adjustments. Well, if you make, if you're underneath the income limits and we can waive those, well, cool. Now we want to look at that conventional because it's going to be more attractive. Mm-hmm. Then on top of that, you have reduced mortgage insurance requirements. So you get some additional savings there. Going back to that theme of numbers never lie, you still have to go through and compare FHA to that. There's pros and cons to each. Some additional requirements there with Home Ready and Home Possible. You have to do home buyer education. Not a big deal. It's a couple hours online. They give you a little certificate. I don't know that it helps, but it certainly doesn't hurt anything. There's nothing here. I'm just scrolling through the guidelines to see if there's anything I missed off the top of my head, but that's really it. Is if you qualify, they're going to give you a better deal. And you're also going to have to do home buyer education.
Yeah. What I'll say is, when I hear that, Josh, you got to be 80% of the area median income. I mean,
you're not buying in Southern California.
Yeah. You're not buying in a lot of areas. You're almost in a rural area at that point. And if you're in a rural area, you should probably consider a USDA loan for many reasons. Because you actually get a higher income opportunity and, probably better rates. I mean, it's hard to say, but I would say definitely get all of your options on paper at that point, side by side comparison versus just saying Home Ready or Home Possible is the right option for me.
When we only did loans in California, I would have thought very similar to you, but I love using Omaha, Nebraska as an example. Their median income there is like 90% of what it is in LA County. So LA County is higher per their tables, but there's lots of homes for $225, $250 in Omaha. And instead of $115,000 or $120,000 median household income, it's like 92 or 94. You can buy a $250,000 house with a $94,000 household income. And if you're going to be at 80% of that, you get 72. So $72,000 is $6,000 a month. That person can probably buy a $225,000, $250,000 house. So there are markets around the country, mainly in the Midwest, upper Midwest, where this actually happens. It's just not most of the expensive markets where people are wanting to be. It's difficult. A $450,000 purchase in most markets with current interest rates is difficult.
There you go. The lender has spoken. Josh, how hard? I'm asking the question. It's coming from me. How hard is it to get a HELOC?
Depends. How well qualified are you? It's no different than any other loan. Like if you got a 400 credit score and you lost your job yesterday, it's really hard. Really, really hard. If you have an 800 credit score and you got 50% equity in your property, and you have a salaried job making $200,000 a year, super easy. So really, it's a combination of debt to income, credit score, and how much equity you have in your property. For the right person, we had a listener to the show right now, and then a past client that are both doing them, and very, very simple. Both of them qualified for an appraisal waiver. They've got a nice bit of equity in their property, and we got an automated valuation that brought back the value. Very little in fees there, less than $1,000 for each of them. There are banks and credit unions out there that will do them for free. You're gonna have to deal with a bank teller to do that, but low cost, and it just comes down to qualifications.
There you go. So hopefully that answered your question. It was coming from me on the channel. I said me, get it? Kind of a play on words there, Josh. Anyhow, not a lot of questions in here. So
they want us to get to Wing Wednesday early, Jeb.
Wing Wednesday. How many of you have a good wing spot where you live? I want to know. Tell me. And if you live in Southern California, where do you eat wings? That's the better question here. And if you say Wingstop, I'm going to jump through this camera. Or Buffalo Wild Wings.
Well, just one step above those, Jeb, was Fire Wings over there in Fountain Valley.
How is that?
See, it's gone. It's already gone.
No. Well, there's Fire Wings is in Seal Beach at that Second and PCH.
That one is still there. The one over in Fountain Valley is already out of business.
How is the one in Second?
It's a really good wing stop. Let's say that.
Okay, Hooters. Do we have a we have a Hooters?
We still have
Fountain
Hooters
Valley?
over in Costa Mesa.
Costa Mesa.
I'll go with Buffalo Shrimp. Their Buffalo Shrimp is. I'll at least give it a B.
We have some good spots. I mean, so what I'll say is Rip here.
Rip I don't love their flavors, but I don't know how they cook those things. I don't know if what they're doing to them, but they are delicious.
We used to get them grilled. These definitely are not grilled, but they're good wings. What I will say, I want a selection. I want multiple selection. Not, BJ's have a couple, but I don't want heavily sauced. I'm more of a dry rub. You can sauce them, but let's not cover up the wing. We're getting really off track here, Josh.
No one's asking any questions, so all we can do is talk about wings because it's Wednesday.
Fair enough. Or hump day. We could talk about humping. It's Wednesday. No, in all reality, let us know where you're watching from right now. That will be helpful. We'll just have that conversation.
No one told us. You asked at the top of the show.
I know. People don't care anymore. They think, hey, we've already told him where we're watching from. We don't need to tell him again.
Jeb, if we want the viewership to go through the roof, do you want to play for them the video of my phone call this afternoon?
Josh lost it on a caller. What do we call these people?
Call center dweller.
A call center, not in the United States. And Josh lost it on them, and I decided to go in there and record him going off on them. I waited though. I didn't even get the best part of it. I was actually trying to text on my phone, voice dictation into my phone. For those of you who ever get a text from me, chances are I didn't type it. I talked it in. But anyhow, I was talking it in, and all it kept doing, mind you, Josh's office is not right here beside mine. I mean, he's a good 15, 20 feet away from me. And all it could do was pick up what he was saying in my phone. So I was basically telling the person I was texting to F off and do all kinds of crazy things that Josh was telling this person.
They know I would never say
there is a video, Josh. I could play it. I'm not going to play it, but I'm going to use.
Let's just say this. For the fifth time, he told me that on the contact us page on my website, I needed to add a checkbox so the people would know how I was going to contact them. I said, in not as nice of way, the fifth time, how in the world would I contact someone just because they looked at the contact page on my website? It's not an opt-in form. They're not asking me to call them. They're not giving me.
We're getting him riled up. We've got to change the subject, or he's going to lose it.
We got Western North Carolina. Is that Kinston? Is Kinston Western North Carolina?
No, that's Eastern North Carolina. North Carolina, baby. We got Vegas in the house. Watsonville, California. Where's Watsonville, Josh? Do you know that?
I don't know.
I mean, that's from the SF
Isn't it
miners.
near Bakersfield, or am I crazy? Is it
I'm going to
further?
think I'm going
It's
to go
further
Northern
north. It's
California.
further north. LaGrange. Where's LaGrange, California?
I don't know, but there's a LaGrange, North Carolina. That's, about 30 minutes from where I grew up, 25
That's
minutes
not
from
where
where I grew up.
Kimberly's at. She's in
That is
California.
not it. But in like Flynn says, closing in April, you think we may continue to see the downtrend in rates. Josh, are you a gambler and willing to say that rates will be lower in May than they are right now, or April rather?
I have not wavered. I expect rates to move lower than what all of the forecasts are. So I don't expect some magical, wonderful improvement. I'm not sitting here going, hey, next week rates are going to be a ton better. I think the markets are skeptical and will slowly grind lower at a better clip than most people are expecting.
All right, good stuff. We got Cincinnati, Ohio in here. And RR, I hope you're still here. I have a question. I've been trying to explain to my 10-year-old that Washington, D.C., first off, is different than Washington State, but also that it's not a state. He doesn't understand it. And he started asking questions. He's very curious. And he said, okay, so when they're filling out a form, what state are they selecting? And I said, they're selecting DC. He goes, well, it's not a state. I said, you are correct. So what state do they select? And he said, maybe it's Virginia. And I said, well, maybe it's Maryland. Like they were all right there. Like, I don't know. So on my website, referral, jebsmith.net/ DC is not an option. If you're in DC, you cannot select your state. So what are you going to select? I'm curious.
It's a tough.
Do you know this answer, Josh, or no?
It's DC. DC is a state. It's not a state.
It is not a state.
But for those purposes, it's treated as a state.
It's not a state. We can't say it's a state. It's not a state.
It's not. But for the purposes of declaring your state,
Gaza might be a state before DC's a state.
Listen, you're going to get Cassim mad. You're going to get Cassim riled up. He's going to come in and punch you tomorrow.
DC.
So
what do we got?
Jeb, we got a follow-up question, and I love this. It's a great follow-up question, and I am remiss for not going through this. Andy says, thank you. Pittsburgh buyer. My lender told me that my wife and I can qualify for Home Ready or Home Possible if we only use my income. But both of our names will be on the deed. And you're like, okay, is he telling me to do something hinky? Should I not do this? For Home Ready, Home Possible, and for any conventional program through Fannie and Freddie, you do not have to use any income that is not needed to qualify. So in this case, we're saying we don't need to use your wife's income. She can be on the loan, but she doesn't have to be. She can be on title and not on the loan. Some programs like USDA, everyone in the household.
That's a big difference. I was going to say
so
that.
Like if she's not going to be on the, if it's your sister and she's going to live with you, they want to know how much money she makes and it would make you ineligible. So Fannie Freddie, you're fine if you don't need it to qualify. So let's say you're listening and you go, well, hold on, for what I want to buy, my salary is underneath the income limit, but I make a $50,000 a year bonus or $50,000 a year of commissions. No worries. We don't use it. We're just going to give you your base. You qualify off your base, you're good. So it is a very good loophole. And I would say pat on the back to your lender for knowing that, because most loan officers, you've already heard us say, at least 80% are worthless and wouldn't even know that what Home Ready and Home Possible are. So not only did he know it, he knew a way to squeeze you in the back door. So definitely going to be beneficial for you if you can go that route.
Len says, how does your rate watch program work? Do I get referred to a local lender after signing up, or do I get contacted when rates are low? I'm looking to refinance soon. So no, you go into our list here. You're not getting referred out to anyone. As rates go down, we'll reach out. So it's either going to be Josh reaching out here directly. 99% chance that Josh would be the one doing your loan. If not, we have David, who is one of our preferred lenders in the states that we're not licensed, or states Josh's not licensed in, that can do it. But you would know that by having a conversation with us. So you're not just going to have some random person calling you.
And it is a system that does this. I don't sit there and look at the entire list of 70 or 80 people that we have on there, plus hundreds of past clients, and go, hey, who's eligible or who could benefit today? It goes in, it knows your loan type, knows your credit score, it knows where the market rates are. And I get an email that says, hey, these 3 people could benefit by looking at a refinance right now.
All right, I'm going to go back to this question real quick. RR says, or comment says, for those purposes, yes, as Josh mentioned, yes, I get what you're saying there, but understand we only have 50 states. Washington, D.C. is not a state. So if you're selecting a list, if there's a drop down list
Hold
of
on.
what state you live in, what state are you selecting?
Hold on. You're trying to tell me there's only 50 states,
I am.
but in one of my favorite songs, my friend ODB talks about 52 states. So you're telling me ODB was wrong. There
I
are
am.
not 52 states?
I'm not. That's exactly what I'm saying there, Mr. Josh.
I'll
There
ride
might
with
be soon
ODB. I'll ride with ODB.
once we
Canada?
take over Canada.
Canada will be the 52nd.
Gaza, and let's just hell, Mexico. Let's take it. We'll have 53, and then we can add DC. We'll just make DC a state where I go to 54. These are all things. I mean, the reason I bring this up is because if you're a loan officer, you have to be licensed in DC to do loans there. Am I correct, Josh?
Yes.
Okay. So in that case, you have to be licensed.
It's like getting licensed to do loans in a city.
In this area. But I need to be able to inform my son. You know, he's asking good information, good questions, and I can't give him good answers because I can't answer it.
If I get my DC licensed, is it a state license?
It is not, because it's not a state.
I don't know. I don't know.
This is crazy
Jeb,
talk.
we're going too long on this.
Last question.
We've got two good questions that we're going to get to. RR gave you the info you were looking for, and he has a question, or they have a question they would like answered.
Let's hear it.
Why did you take it off?
Why did I?
Yeah, stop messing with the screen, bro.
I didn't select anything. What you got?
Can you explain a zero cost refinance for a VA IRRRL? Easy. And how starting a new 30-year mortgage helps or hurts me. So the second part applies to everyone considering refinancing. A zero cost refinance of any type. So a VA IRRRL is easier to do a zero cost refinance because we have less costs. We don't have an appraisal. Most lenders are going to discount their underwriting fees, waive processing fees, all of that fun stuff. What you
I'm laughing at a comment. I'm an idiot. Anyway, go ahead.
You're disrupting the show, Jeb. So from that perspective, what you need is a lender credit to cover all of those costs. So say it's a VA IRRRL, no appraisal, $2,200 of costs. It's a $400,000 loan. We need a half point roughly to cover that for you. So you're going to take a rate about 0.125 above market. That lender credit comes and wipes out those costs. So you're not adding anything to your loan. So the second part of your question is, what about starting a new 30-year mortgage? How does that help or hurt me? You don't have to. So most loan officers are going to say, here it is, here's your new 30-year loan. But if you want a 27-year loan, you want a 22-year loan, you want a 28.5-year loan, you can do that. So the question becomes, do you want the lowest payment possible, or do you want to stay on track to keep paying that mortgage off? That's really the question. And that is the crux of the conversation when you're going through a refinance. What are my options so that you can look at them, look at the numbers and judge and figure out which is best for you?
All right, good stuff. The reason I was laughing is because we got a comment from Jules of Mexico. She quoted me, says, let's say Mexico, hell, let's take it, and then puts the crying emoji faces. Yeah, that was, I wasn't saying that.
No, that's exactly what he said, and that's what he meant.
That is what I said. But I don't agree that we should be taking.
He wants
Mexico,
another executive
Gaza order. or any of these. I'm poking fun at the craziness of the comments that come out of this guy's mouth sometimes, and some of the things that are said. So I don't agree with it.
So thanks to Trump, ODB is going to be right by the end of the week. Is that what you're saying?
Just hilarious. But I mean, some of the comments that are made are just too good. There will be great content for the better part of 4 years just because of some of the things that are said and how they're said. Often it's not what is said, it's how it's said that 100%. Makes it just absolutely nuts. One question here that came up a moment ago, we're going to answer real quick. Me says, if two people are on title, do they both have equal share of the house? So it depends on how title is held. I don't know if, maybe Josh, you probably know this, of title ownership, like how you can hold title is different in different states. I assume that it is because not every property is a community property state and so on and so forth, but there's different ways you can hold title. Sometimes you can hold it as joint tenants. Sometimes you can hold it as tenants in common. You can hold it as community property. You can hold it several different ways, and how you hold it dictates ownership in some ways. You have to declare what that percentage is in some of these cases. So that's how it works in California. I'm assuming that's how it works in other states with title and how titles, tenants in common and all this other stuff. But that's a Josh, can you answer that? Or do
So
you?
joint tenancy can't be separated. I mean, it can be separated, but if you own a property in joint tenant, Jeb and I go and buy an investment property. We want to buy a new office. We don't want to rent anymore because it's hypothetically the landlord sucks and we don't want to be underneath them anymore. So if we go buy that property together and we do it as joint tenants, that would not be smart because I would need to go to court to say, I don't want to own it as joint tenants, or I don't need to go to court. Jeb would have to go, I agree. We were dumb. We should not hold title together as joint tenants. Because what would happen is if I walk across the street to Chipotle at lunch and a bus hits me, Jeb is now the owner of that property.
Hell yeah, baby.
I can't leave that to my heirs. Can't leave it to my wife, my dog, any of that. By the way, the Lewises are going to have a second dog here in a few days, Jeb. Not permanently, but we'll have pictures for everyone next week of the expanded temporarily Lewis family. But in that situation, that's why joint tenancy would really only be with a spouse or with someone that you want, because there's just one interest there. And I believe that community property is the same. If you want to do it where you can separate your interests, tenants in common, if we had a title person here, they could tell us for sure. Tenants in common, Jeb and I could say Josh is a 65% owner
Sure.
and Jeb is a 35% owner, and Jeb could take his 35% and sell it to Susie if he doesn't want to be a partner with Josh anymore. So those are the things that you need to go through in terms
and
of
you can hold it in a trust, you can hold it in an LLC. There's multiple ways that you can hold title that dictate ownership in different ways. So just talk to the right, wherever you are. If your realtor doesn't know, as real estate agents, we can't tell you how to hold title, right? It's
legal advice.
We can't give you that advice, but we can tell you what they mean, like Josh did, and ultimately you can make the decision, or better yet, you can talk to an attorney or somebody else and get that advice. And that's essentially what I would recommend. So Josh, we've been on for an hour and 10 minutes now because we started a little bit early. Super Bowl predictions. Not who do you want to win? Better yet.
Listen, Saquon bought me new golf clubs, so I'm firmly in Team Saquon.
I want the Eagles to win. The Chiefs they just always look so damn good. And they don't make a lot of mistakes, man. They don't make a lot of mistakes. And so it's hard to say that they're going to go down until they actually go down. So I'm going Eagles. I'm going Eagles because that's what I want to happen. But if you told me, or if the Chiefs win, I don't know that I would be surprised. So anyway.
Jeb, we had a great comment again for miscellaneous of the whatever. We would have New Mexico 2.0 and New Canada. Then we have 52 states. So there we go.
And then ODB's right.
ODB's right.
He's like a fortune teller. He just sees into the future.
The Oracle. He was a very wise man. Everyone who knew him knows.
Like Buffett.
Very wise man.
The Oracle of Omaha.
So Jeb,
guys.
We got one question you're going to answer before we head out. Saul, seller did not pay for solar panels leading up to sale. $2,000. Now sale is a standstill. What should I do?
Seller did not pay for solar panels leading up to the sale. So, okay, so I'm assuming there was a lease on it, and the lease is owed $2,000.
Lease or a purchase agreement. Closed. You can get a loan on them also. It says it's a standstill. I think he's not able to close because the seller was supposed to pay for it.
Yeah, then that's on the seller, right? They've got to, I'm assuming, bring it current in order for you to sell or whatever your plan is. So, theory, you're not out of contract because you're waiting on the seller to do something. So your options are give them a notice to perform to have that, done, right? Pay it off so you can move forward. A demand to close, whatever you want to call it, or you could have the opportunity to back out, right? But here's the thing is you can't just back out of a contract, at least in California. You can't just say, okay, you haven't closed, I'm out. You've got to give them a notice before you can do it. And the way the contract's written in California, at least, you got to give them 48 hours unless that number was altered in the original agreement. So if you want,
it follows up and says, I accepted loan moving forward. So they still owe $2,000 and you just said, screw it, I'll pay for it for them. What I would go back to, and Jeb, correct me if I'm wrong, this is your area of expertise. It should have been in the initial contract, right? There is solar here and an encumbrance on the property. Here's what should be done with it at closing.
Yeah, I would say it's never we never lay it out quite like that. Could it be? Sure. solar panels are one of those things that, like, listen, it's on the property. In order for it to transfer, the lease has to transfer. So my guess is, even so, you're assuming the lease of it, but you can't close until the $2,000's paid by the seller. I say, tell the seller, hey, listen, if you want to sell your damn house, pay
Holy
your balance.
They owe
There must be
$80,000 on
100
the
panels
panel.
on that house.
This must be the biggest solar installation this side of the Mojave Desert. What are we doing here? $80,000 of solar. By the way, it's a dirty little secret that most people have no idea what solar should cost. So you can get 2 and 3x markups depending on if you answer the door when the guy's going door to door offering to slap them up on your house. Let that be a lesson.
Yeah, yeah, that's a lot, man. Sal, that's a lot, dude. 80 grand for solar panels. I mean, that house, it's got to be producing, like, your utility bill's got to be like $1,000, $1,500 a month to make that make sense. I mean, this better be a damn estate for having.
Like, literally, if it cut, that's 800 months if it saved you $100 a month. Like, what are we talking about?
Yeah, I don't know. I need more info, Sal.
That's
Feel
Saul.
free to email me. Sal. I'm
Two different people.
It's a white guy.
Two different people.
It's a white guy saying Saul. Saul.
You know,
it's actually Saul, right?
Yeah.
But a white guy over here, right? Gringo. That's, we can't take over Mexico. I can't even
can't speak the language.
I can't say these words as it is. $40K for purchasing them, $40K for install.
Both are batshit crazy. Again, unless this is a mansion with the largest solar installation.
Send me a picture of the roof of this.
Yes, I would. I want to see this.
Seriously,
we're going to show it next
serious. Yeah, let's get more info. Saul. Sorry, dude, I keep butchering your name. All right. It's time to go. Next week, we'll be back 5 p.m. I think next week. Let's get it back to regular time. It didn't change anything with the viewers, so we're going back to old school. Until next week, guys. Adios.
Amigos.